Ajay Tygai, the Portfolio Manager of UTI Bluechip Flexicap Fund. Today I shall be talking to you about the investment philosophy around the UTI Bluechip Flexicap. To start with, let me say that the philosophy is built on the three pillars of quality, growth and valuation. Let's start with quality. The surest way of defining quality is by measuring the return on capital employed or ROC of a business. Businesses that have high ROCs that are sustainable through good and bad phases of the economy are the ones which possess this quality attribute. Such businesses generate economic value year after year, which is nothing but the difference between the ROCs and the cost of capital. Such businesses which keep generating economic value and in fact grow it year after year are the ones which are long-term wealth creators. The corollary to this is that businesses which generate poor ROCs or ROCs which are at or lower than the cost of capital would never be wealth creators. In fact, they destroy wealth in the long term. And as a philosophy, we always try to avoid such businesses. So as a last point, if you think about all the great wealth creators over the last decade or more, you'll realize that the common thread running through all of them was a high return on capital employed that was sustainable through the cycle, and hence they generated long-term wealth. Our endeavor is to keep focusing on such kind of businesses and never look beyond this universe to construct our portfolio. Let's now talk about growth. Once we have figured out such high quality businesses, we need to raise the bar further and find out businesses which have high growth. High growth is important because if businesses don't grow, then the economic value that they generate year after year would stagnate and therefore wealth creation would stop. One would not lose money in such a business but would also not generate satisfying returns. For long-term wealth to get created from the point you have invested into a business, the economic value year after year should be increasing. Typically, these are businesses where the penetration of the goods and services that they are providing is very low, and therefore their ability to reinvest for the future is very high. So year after year you have a string of ever increasing economic value which when compounded leads to long-term satisfying wealth. But remember, it is quality first and then growth. A business which does not generate economic value but continues to grow in fact destroys wealth and does that at an accelerated pace. One should avoid such businesses as these are growth traps. The last point on my philosophy is about valuations. Valuations are very important to get a good entry point into a great business. Although PE is a very good starting point for understanding the valuations, but it is also a misunderstood and widely abused metric. Imagine two businesses, both of them growing at about 15% for the next 5 years. One of them trades at a PE of 10 and the other trades at a PE of 25. Before reaching to a conclusion that the first business is an attractively valued one, we will have to go back and understand whether this business generates sustainably high ROCs or not. More often than not, a high ROC and a high growth business would warrant a high PE and would still be an attractive investment for long-term investors who invest on the basis of underlying fundamentals rather than on the basis of what's going to outperform in the next few months or quarters. Therefore, before reaching to a judgment by looking at PEs optically, one has to look at the characteristics of each business and on that basis determine the fair valuation band for each of the businesses. Well, that is for today. Thanks a lot for your patient listening and have a good day.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.